Following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we're going to be talking about money. You know, there are some things that are constant. They're constant year after year, decade after decade, century after century, millennium after millennium. Some things are absolutely constant. The amount of water on the earth is a constant. So as you take a drink of water, know that that drink of water you're drinking could have been, at one time, a dinosaur could have drank that same water. Or an elephant, or a lion, or a Native American, or someone from East Asia, someone from Europe, someone from Africa. That same water you're drinking, because that's a constant. But if that's a constant, there's a lot of the world which is changing, not just year by year, but day by day, minute by minute. And that's the economy. That's the economy, that's the stock market. And that's where our focus is. That's what this program is about, is the changes that are going on. Now, there's a lot of people who are predicting, looking at the time period from December of 2021 to January of 2022, they were predicting that that was the beginning of a crash that was going to take us down, the Dow down to less than 10,000. At that time, the Dow's 35,000. They're talking about a crash that's going to take it down to less than 10,000. It's going to be blood in the streets. We're going to talk about that today. We're going to talk about the lessons that are learned from that. There are some people that are not predicting a crash, but they said that a lot of stocks were in a bubble. In a bubble. They were way overpriced. They were due to come down. They were due to get beaten up. They were in a bubble. So we're going to talk about that today as well. There's a difference between a bubble and a crash. A crash tends to be worldwide, although it can be nation by nation. But there's a difference between that and a bubble. And, you know, if you take a look at the graph of the stock market, it starts in the lower left-hand corner and it finishes in the upper right-hand corner. And if you just look at a graph on a paper from 1929 to 2022 or 2000 or whatever it is, it looks like it's a graph that the line just goes up with a couple jiggly parts in it. But if you get up close, that can be terrifying. And so when you look at that time period, December of 2021 to January of 2022, or you can look at the time period from February of 2020 to April of 2020. Those time periods can look terrifying, but we're going to look at those and we're going to visit those and talk about why they do or do not exist. We're going to start talking about financial crashes. I find it humorous that so many people, not so many people, but there are those that talked about a crash. One of my favorites is James Dale Davidson, who claimed he predicted the crash of 2007, 2008. And he wrote a book. It was a book called Blood in the Streets. It was published in the mid-1980s. And he said the crash was going to happen not in 2007, not in 2008, not in 2006. He said the crash was going to happen in 1987. Blood in the streets. And as it turned out, that We did have the Great Recession, and his reasons for saying it was going to happen in 1987 have little to do with what really happened in 2007. But now he claims that he foresaw it. You know, there are a number of people who claim they foresaw that crash of 2007, 2008, 2009. They saw it coming. They predicted it. And were they right? There's very, very few people who really predicted that we were going to face a crash. If anything, I could say I did, on the same basis that other people have said that they predicted the crash of 2007. In 2006, I wrote a newsletter. I wrote a newsletter that said real estate was getting cooked. It was getting to a state where things were really crazy. And I wrote that newsletter because I had gone to a conference in Phoenix, and on the plane, on the way back, I sat next to a guy who was a house flipper. And he said that he owned 6 houses, and the way it worked is that you only had to put 10 or 15% down, and you hold on to the house for a couple of years, and then you flip them for a 20 or 25% profit. So you almost double your money in 2 years. And I said, oh, and you offset with rent. He said, no. In the beginning, he was renting the houses, but that puts wear on the houses. It's better just to let the houses sit for a couple of years, make the payments, and then after 2 years, you put them back on the market. The price has gone up 30%, 35, 40%. You take your profit. You take the money that you borrowed for the house and for covering the payments, and you walk away with a double on your money after a couple of years. You know, I said, this is a little crazy. This real estate market is overheated. This is going to come crashing down. But I never, while I expected a credit crunch and I expected real estate to have its problems, I never ever foresaw the kind of crash that we had, the kind of Great Recession we were going to have. We didn't have a credit crunch. We had a credit crisis. So what happens with a credit crisis? You know, when you look at all these people who are predicting now, or are predicting in 2022 or 2024 or 2010, they predict that the market's going to crash and everything's going to come tumbling down. What are they predicating it on? When you really look and when you turn to the experts, what is it that causes a crash? There's a book out, read it a number of years ago, called Slapped by the Invisible Hand, The Panic of 2007, written by Gary Gorton, who was a member of the Federal Reserve, graduated from Wharton, graduated from Yale. Not a stock market genius, not a guru, not trying to sell his wares to the public, not trying to get people to invest with him. I've been to conferences where people will give a presentation saying that we're going to come crashing down, but there's a solution to it. What's the solution? Well, sign up, put your money with me, and I'll get you through it. You know, that's not the motivation Gary Gorton had, or other people that were similar to him that wrote the same way. Gary Gorton had a specific thing to do. He was studying and looked at the crash of 2007, and it wasn't something that was a new thing, because we've gone through that before. The invisible hand, of course, is what's another name for the economy. Slapped by the economy, slapped by the invisible hand. And the panic that went on in 2007, 2008 was not that much different from 1907 or 1893 or 1836. You know, that period of time that we went from 1934 to 2007 was a very special time. We hadn't gone that long for a long, long time. I don't think the world had gone through anything without having a panic for that length of time. That period of time was actually dubbed by economists from 1934 to 2007 as the golden period. There were economists, any number of economists that said, we will never have a Great Depression. We understand what a crisis is and how to avoid it. We had those crises, however, in 1796 and 1834, 1848, 1874 to 1913, we had 6 of them, and then 1929. For Sherlock Holmes, he said, you see, but you don't observe. You know, the fact is, through that period of time, there's common elements, not just in those periods of time in the U.S., but worldwide. You can look at worldwide. And there was only one difference between 2007 and the previous panics, is that all the other panics, people could see, everyone, it was visible to everyone. 2007, it was only visible to insiders. That's what was going on and different in 2007. People only in the know who knew what credit swap defaults were, repos, CDOs, credit. Previous individuals had feared that their savings were going to go out, but with FDIC passed in 1934, it was not the individuals who were concerned. Now we're going to come back and revisit this, and we're going to look at all these items. Lots to do.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So, I've been talking about the gurus, those who take the period of time from December of 21 to January of 22 as being a time in which it's the precursor to a crash, or it's a precursor to a bursting of a bubble. You know, you get people that are focused on this from a stock perspective, but I think there's lessons to be learned and a time not to panic. Bank panics is where I went in the first part of this program, talking about those bank panics, not according to the gurus, but according to the people who study it, who know what happened. And what we see is what happened is a credit crunch, a credit crisis. It was a crisis of the banks and the financial institutions. What was different in 2007 from previous times is that in previous times, those times in 1796, 1834, 1848, 1874 to 1913 and 1929 and those times, it had been visible to everyone. Everyone could see what was going on. The banks had overloaned. The banks were having trouble collecting. The economy had slowed down. People were not repaying the loans, and the banks were beginning to have a problem giving deposits back to the investors. That problem was, to a large extent, solved in 1934 because of FDIC. But by 2007, beginning in 2075, or 1975 exactly, 1975, you had financial institutions growing up that were not banks. You had the auto companies that were running their own credit. You had GE running their own credit. You had any number of firms that had set up to capitalize on loaning money. And they were not under the control of bank regulators. So as they made those loans, and you had institutions who had large sums of cash, endowments, institutional hedge funds, all those people who had big sums of cash, far beyond FDIC's guarantee of 100,000. They had 100 million or 75 million or 200 million. And they required some sort of guarantee. And those guarantees became repos and CDOs and the repos were further set up with credit default swaps. And all those things that were going on created an issue, and most people did not see what was going on. The individual person on the street didn't see what was going on behind the scenes. In the previous times, when you had a bank that was having trouble because they couldn't repay their depositors, you would have a run on the bank. You would have a panic. You would have individuals running to those banks to withdraw money. And of course, that was the panic that set in. That was the Great Depression. That was 1796. Those times happened. They were a credit crisis where banks could not pay off their depositors. In this case, not only were the banks in trouble, the brokerage firms were in trouble, and some of the financing companies were in trouble. And we had what was called a systemic risk, actually, the risk of a panic. You know, if you look at where we were at the end of 2021, the beginning of 2022, the banks were in good shape. Not just the banks in the U.S., but the banks worldwide, for the most part, were in good shape. They were not overextended as they had been during the Great Recession, overextended with houses, and when housing prices came down, the bank's collateral collapsed. No, the banks are in reasonably good shape, and they do a stress test every year to show that what kind of shape that they are in. So the people who are predicting and thinking that we're going to have a credit crash, it's not really going to happen. They're not in bad shape. There's not a country that's in really bad shape, except maybe China, but that's a whole different story. They have a lot of money coming due for government debt. And it's not just government debt that drives a credit crunch or crisis. It is the entire banking system, not just the government, although the government can come into play, but we're not there yet. We're not there yet. So when people talk about that time period, was the stock market collapsed and corrected in December of 21 to January of 22, it was not a panic. It was not the beginning of a Great Recession. It was a normal time of a correction. So there are those that say it was a bubble. You know, let's talk about bubbles. Let's talk about bubbles. There's a classic book that was written, it was written 150 years ago, in fact, that talked about one of the most famous bubbles of all, tulip mania. And when people talk about bubbles, people illustrate it with tulip mania, because in the mid-1600s, tulip bulbs were shipped from the Ottoman Empire, and they became a luxury item in Holland. Prices began to increase, and by 1634, you had speculators in Holland who were speculating on tulip bulbs. By 1635, prices had risen so high for a tulip bulb that for 40 bulbs, you could get 100,000 florins. Now, the florin was the currency at that time of Holland. The average yearly wage for a worker in Holland was 150 florins per year. Not 150,000, 150. But if you had 40 tulip bulbs, you could sell them for 100,000 florins. It was 16 2/3 of a year of wages to buy 40 tulip bulbs. You could trade those tulip bulbs, 40 bulbs, for 1,000 tons of butter. You could trade 40 tulip bulbs for 3,000 sheep. You could trade 40 tulip bulbs for 2,500 oxen. 2,500 oxen. By 1636, the price had increased so much that you could trade 2 tulip bulbs for 12 acres of land. Those tulip bulbs made people rich. If you got in and your tulip bulbs sold a few months or a year later, you made a ton of money. There's the story about a sailor who hadn't heard about this. He comes into Holland and had a friend. Friend invited him to dinner. This sailor, who had not heard anything about the tulip bulbs, picked up the tulip bulb. He thought it was an onion, started to eat the tulip bulb. He was immediately arrested, and almost hung for taking a bite out of a tulip bulb. You know what? In February of 1637, the number of buyers ran out. No one anymore wanted to buy tulip bulbs. Prices crashed. The bubble burst. That's the very famous tulip mania. That's how it went. Think about it. 2 bulbs would get you 12 acres of land. 40 bulbs would get you 2,500 oxen. You could trade 40 tulip bulbs for 3,000 sheep. And the price only went up from there. That's where things happened until things came crashing down. Now, we had another bubble in the not too distant past, the dot-com bubble. I lived through that. When you look at the valuation of stocks, they have assets. You can measure the revenues, the earnings. They have a balance sheet. They have income statements. They have cash flow. During the dot-com time, there was a complete change. If you look at Microsoft during those days, what was happening with Microsoft in the 1980s and 1990s? What was happening is the computer memories were doubling every 18 months. I can relate my own story. In the mid-80s, I bought my business computer and a home computer. I had 100 megabytes of memory in my business computer, 60 megabytes of memory in my home computer. I thought I was set for my lifetime. How wrong I was. Computer memories were doubling every 18 months, and that meant that the programs could double in size every 18 months. And that's what happened. If you look at that period of time in the 1990s, early 90s, middle 90s, what was happening is the internet was doubling every 6 months. The potential was huge. But as things began to flow along, and as companies came public, it wasn't about earnings. It wasn't about revenues. It wasn't about income statements or balance sheets or cash flows. It became about page hits. It was the new paradigm. People talked about the new paradigm. History was different. This time was different. And even as we reached that point, people knew that it was going to come crashing down. But it was like an addiction. People couldn't stop. Day traders, people in the gym, grocery store. I remember seeing 2 women in front of me at the grocery store, and one was saying to the other, "You just have to buy stocks. You can borrow on your Visa card and you only have to pay 18% interest." That was a bubble. Looking in the rearview mirror, we can see that. Those are bubbles. We're going to come back and talk about this time period, December 21 to January 22 again. What did we learn? We're not in a bubble, but we'll come back to this. Stay with me. We've got more to go.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
I've been talking about this period of time from December of 21 to January of 22, and all the comments that were coming out, the gurus who were predicting we were at the beginning of a crash period that was going to take the Dow down less than 10,000. Or we had stocks that were in a bubble. These high growth stocks were in a bubble, and it was going to burst, and they were going to come crashing down. Neither one is really true. Gerard Baruch said it, Art Cashin paraphrased it, and he said that the market's a perception market. If it believes that 2 plus 2 equals 5, they'll pay 4 3/4 for it all day long. And my corollary is that if they believe that 2 plus 2 equals 3, what they bought at 4 3/4, they will sell at 3 1/4. There's a difference between a stock price and a stock value. And people begin to forget that. They begin to get confused about what is the value and what is the price. And that's where we went. But as things come crashing down, this whole principle of what they thought was going to be 4 3/4, suddenly when there's a little bit of news which isn't good news or perceived to be good news, the things come crashing down from 4 3/4 to 3 1/4. Sometimes from 2 plus 2 equals 4 comes crashing down to 3 1/4. There's not a real reason for it to happen except for perception. It's an emotional thing. What the market is millions of people making millions of decisions based on incomplete information and on an emotional and psychological level, sometimes with reason, sometimes without reason, but most of the time without all the facts. That's what the market is. That's what things are going. And you see that clearly in that period of time, December 21 to January 22. It's one of those times where people looked at it, and as the market came down, as some of the stocks came down significantly, down 30 and 40 and 50%, people suddenly panicked and blew away what was going on. Were they wrong when the stocks were at 200%? Were they wrong when it was at 100%? Were they wrong when they were down 50%? People tended to overreact. People tend to overreact and look at a partial amount of knowledge. And you also have to think about one other thing. Most of the trades, 60% of the trades that are being done in the market today are done by computers. Computers. They're algorithms that are driving trades, and those algorithms have no human intervention. So humans have written the program, the computers learn from their own things, and the computers read all the information. They look at past history. They compile all that information. Bloomberg and other sources write news specifically to be read by computers. I relate the example. I had a person on my program once who wrote an algorithm for peer-to-peer lending. Peer-to-peer lending comes up, and he had several investors. They invested in $1,000 segment or $1,000 increments in peer-to-peer loans, and the loans were generated by LendingTree. LendingTree on Thursdays at 2 p.m. would release the loans that they'd made in the previous week, and he had written an algorithm that would go in, look at all those loans, look at every one of those loans, would do a credit evaluation on every single one of those loans, and then would take the top loans, and for whatever money he had, was it $10 million or $4 million or $2 million or whatever he had, he would buy those number of loans and repackage those loans into $1,000 increments and put them out to his clients. And all that happened within 1 second, less than 1 second. So by the time an individual person, a person like me or you who are listening, by the time you read the name of a loan, all the very best loans were gone. Every single one. Now he sold this algorithm to somebody, to a company, and walked away and moved to France. And the last I heard of him, he was living in France. But that's the kind of information that's going on with computers and computer trading. Now, with that being said, computers rely on past data. The computers have no data for a pandemic. They did poorly in 2020 because There was nothing that gave them information on how the markets behaved during the pandemic. And as we come out of the pandemic, they're facing the same problem. Having not been through a pandemic, they're relying on past data, which never was impacted by a pandemic. They're just looking at past data and reading information. And they're reading the gurus who are saying we're coming to a crash. They're reading the gurus who are saying we're in a bubble. They're reading all that information, and computers are making trades based on all of that. Are they making the right trades? No. That's what's happening in the market. That's what happens during that period of time, December 22 to January 20, or December 21 to January 22. It's driven by computers reading information, making decisions on bad data. If you think of the markets, hundreds of millions of people making hundreds of millions of decisions based on incomplete and incorrect data, then you have to compound that by saying the computers are doing exactly the same thing. We'll see as the end of 2022 rolls around and 2023 and 2024 roll around. We'll see how the computers actually did. My prediction is they won't have done extremely well. They'll have misread the data. They'll have read it as if it was data with no pandemic. They'll misread what's going on, and they'll misread individual items, thinking that if there was one thing that wasn't consistent, that things must be wrong. We'll see how the computers did. But there's a lesson to be learned. There's a real big lesson to be learned if you're an individual investor, is to take advantage of that. Now, there's a thing with an accusation against most financial advisors that they say, just hang on and we'll weather through this. That may not be the story of every single stock or every single mutual fund, because some are based on incorrect information. Everybody is relying on not having a full story. So there needs to be an evaluation that goes on, an evaluation of each particular stock, each particular mutual fund, each thing, ETF, whatever it is. It's worth doing a complete evaluation. And that's what we do. We work it through, we look at it, we see what is the long term. If you look at the returns that we presented for our client returns, they start in the lower left-hand corner and go to the upper right-hand corner, and I certainly hope that they continue to do that, and past performance is no guarantee of future results. But if you look in between, there's jigs and jags in that curve, and when you have a jag down, it looks terrifying. December 21 to January 22 looked very terrifying. But the fact is, it was one of those correction type times, and the fundamentals were solid and would continue to be solid. So that's the first issue I wanted to address. But there's something that goes beyond that. The gurus and the people that are trying to move money in, they're trying to get people to buy their product. And it reminds me, I don't know, what always reminds me of something like the time that the Eiffel Tower in Paris was sold by a con artist. And he did it not once, but he did it twice. Sometimes I look at people like Davidson, and I think he wrote those books in the 1980s saying there was going to be a crash. And he wrote another book in 2005. He wrote another book 2015, I'm sorry, not 2005. Wrote another book saying there's going to be another crash. He was 20 years off on 2007. Will he be 20 years off on the next one? Who knows? Eventually there will be a crash, no question. But it is, in my opinion, only a way in which to sell a book, to get people into their managed money, only a way in which to move people along. I believe that the best thing is to hire someone, to find somebody, or to use yourself to do the analysis and figure out, are you in the right place Do you have the right stocks in the portfolio? Do you have the right bonds? Look at the fundamentals. If the fundamentals are right, then you can begin to ignore what's going on. This time period of December 21 to January 22, if it teaches anything, it's that the fundamentals were right. May have been delayed a while, but the fundamentals are right and things are getting better. But if that's one side of the story, there's one other side of the story that I want to talk about as well. And that's for the firms that will actually estimate low returns. So why do they estimate low returns? We're going to come back after this commercial break and talk about those firms, because that's another lesson we have to learn.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So, I want to talk about one other aspect of the people that are forecasting things going forward, because there's one other I think is as damaging as the gurus who predict we're going to have a crash or that we're in a bubble. I think there's another group that also you have to examine. Northern Trust in August of 2021 put out their projection for stock market performance worldwide, just like they did in 2016. Northern Trust put that out. It didn't come to me until January of 2022, but that's okay. They put it out. It was for 2022 through the next 5 years. And they said that U.S. stocks were only going to be up 5% for the next half decade. For the next 5 years, stocks are going to only increase 5% per year. Now, why would they put that out? What did they do before? 5 years in 2016, they said that U.S. stocks would be up just 4.3%. 4.3. How good was their forecast? The actual returns were 18.1%. 4.3 to 18.1. That's what I would call a big miss. So how is it that they would come back after a big miss and repeat the same projection? And I think the answer is that they want to manage their clients' expectations. If they forecast 5% and their clients actually get 7%, they can say, see how much better you've done than our forecast? How much better you've done than you expected? Because you only expected to do 5%. And now you did 7%. See how wonderful you are? They don't say, we projected 5%, you only got 7%. You really did worse than the market by 11% per year. No, they don't do that. They want to come out. So how did they get to the 4.3%? You know, the difference is amazing. If you look at the terms of a $500,000 account growing at 4.3%, it'll grow to $617,000. If that $500,000 would grow at 18%, it would have grown to $1.15 million. More than almost double. 500,000 to 600, or 500,000 to 1,148,000. If you were invested in the stock market, would you really be happy with a 5% return, 4.3% return? Would you be really happy with that if the market was up 18? No. You know, and I've seen a few Northern Trust accounts from potential clients or clients that have come in. The performance is actually pretty rotten. And maybe it's just the few that I've seen. Maybe everyone else is doing wonderfully well. Maybe everyone else is doing 18 to 20%. I don't know. The ones I've seen have not been very good. So why did they get it wrong 5 years ago? Why did they get it wrong? Or why do I think they'll get it wrong this time? So Northern Trust feels there's going to be a reversion to the normal. And that normal is mediocrity. That's their logic and reasoning. a reversion to normal. You know, this whole idea that if the markets really go up a lot, that there's going to be a reversion back to the average. Not necessarily. They expect that the global economy is going to settle into a very low growth channel, and they believe that markets are going to be defined by what they call stuckflation. That means that inflation is going to be rising at an annual rate of 1.7% per year for the next 5 years, 1.7 to 3.4 to whatever, and that those challenges to central banks, as central banks deal with climate change and income inequality, will keep the central banks from dealing with inflation. If you look at what's gone on in 2022 and the concerns that people have with the Federal Reserve raising rates in December and January of 22, the Fed was talking about inflation. But we disagree. I disagree. Standard Chartered Bank, I've talked about for years. Standard Chartered Bank did their study in 2011 saying that there are periods of time in which the worldwide GDP grows faster than average. And since the Great Recession in 2009, we've been in one of those periods of time. First period of time was from 1870 to 1913, driven by the industrialization of the U.S. Second period from 1945 to 1970, driven by the rebuilding of Europe and the decolonization by the European nations. This supercycle is being driven by the emerging nations. Those people are moving from subsistence to consumption. And when they're doing consumption, they're buying products. They're buying their clothes. They're not making them. They're buying food. They're not growing it. They're moving into consumption. That's what's happening worldwide. And if you look at the Standard & Poor's 500, over half of their revenues come from overseas. A lot of that coming from those emerging nations. If you look at all the companies, even those that are not part of the public domain, even those that are private companies, 43% of their revenues come from overseas. So this idea of the supercycle and those emerging nations growing very fast means those companies in the U.S. are going to benefit from that. That's a very different outlook than Northern Trust has. Northern Trust says we're going to slow down even in those economies. They're not going to grow very fast. You know, I think they do that so that they reduce the expectations of their clients. They do that because they want their clients to think they're only going to get 5%. And when they get 7%, their clients are going to be thrilled. That's the philosophy I read into it. Now, they didn't call me up and say, Mike, this is what we want to do. You know, I'm just trying to read between the lines. And I also believe that there's not a reversion to normal. Old companies fade away and die. And there's a new set of businesses. New technology that comes along. Lifestyles change. Technology changes. Demographics change. Think it's happening even at a faster pace. Think of phones. Palm came out with the Palm Pilot, a PDA, in just 26 years ago. Just 15 years ago, there were no smartphones. In the beginning of 2022, there were over 6.6 billion smartphones. 83% of the world's population owns a smartphone. Think about that. Didn't exist 15 years ago. That change is going to continue to happen, and I believe it's driving the supercycle. High-growth economies may be those emerging nations, but U.S. companies are going to benefit from the whole thing. You know, at AFC, we don't do everything right. We stumble sometimes. We get things wrong. We make mistakes. Sometimes in the stocks we buy them for the right reasons, but it turns out to be a mistake. But we're looking at achieving a significant growth in our clients' accounts. We even do a contract that says our goal for clients is to outperform the Standard & Poor's 500. Do we do it? Not always. If you look back over the last 17 years, in 11 years we outperformed the Standard & Poor's, in 6 years we underperformed. We had those years of 40% in 2019, of 77% in 2020, and then a 3% in 2021. We've had negative years, but our focus is not to mislead our clients, not to set our client expectations low, but to really see our clients do well. Anyway, that begins to wrap up the program today. We look at this time period from December of 21 to January 22. I hope you learned some lessons today. And until next week, have a great week. I'll be back to talk about money on Saturday.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program is for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial.